Get you all excited after lunch again. Two sessions on the taxation of goods and services coming up now. I'm going to be talking about the broad taxation of goods and services, and so because of that I'm mostly going to be talking about value-added tax or VAT, but I'll be referring to these as indirect taxes throughout. So the outline of this lecture, there's going to be three sections. The first section I'm going to talk a bit about motivating discussion of indirect taxes in public policy. So I'll talk a little bit about tax system design more generally, and then place indirect taxes specifically in that context. The second section, I'm going to talk specifically about value-added tax and how its specific design reflects some fundamental economic thinking in this field. And finally, I'm going to move on to a more kind of contentious area of debate in this field, and that's whether all goods and services should be treated the same within the VAT system. So starting off with the purpose of indirect taxes. So the first graph I'm showing you here is a breakdown of UK government spending for 2017-18. And obviously we care about taxes here because taxes facilitate the government providing these public services that we care about. So social protection, health, education and so on. People want these things to be provided by government, and without taxation that can't be done. Now here we have two time series of total government spending and total government receipts going back to the 50s, and we see that these two move together for the most part, although in some circumstances they do diverge. But if we look at the OBR's forecasts for how these series are expected to move going forward, we see a massive divergence on current policy between total spending and total receipts, and this is mostly driven by demographic changes, specifically an increasingly elderly population who use more public services, especially health and state pensions. And given this pressure on public spending, we obviously care about the other side of the coin, that's taxation. How are we going to provide these public services? Now you've probably heard a lot about equity and efficiency today already, but it's going to be key to this presentation as well, because clearly the amount of tax revenue that we raise is important, but we also care a lot about how the taxes that we implement affect the population and affect the economy. Now broadly, when I talk of equity and efficiency, I'm thinking about equity being the distribution of things, distribution of the pie, and efficiency being the size of things, the size of the pie. And taxes clearly influence equity in a direct way, in that they take away people's spending power, they take away people's income, and also through an indirect way by allowing the government to provide certain services or certain transfers. Now the problem that we face in taxation is that unless these taxes are lump sum, that is not dependent on the behaviour of individuals, they're going to induce substitution effects. They're going to induce people to change their behaviour, and in general this is going to reduce efficiency. I say in general because in the case of certain market failures, so think of externalities like the pollution from some production, taxes might be welfare improving. But in this lecture, I'm going to mostly abstract from that because the next lecture by Becky is going to look at corrective taxes in a lot more detail. Now because these lump sum taxes are actually, they're efficient, but they're basically impractical in reality. Because if you think about for instance, the poll tax, the same tax for every person in the population is extremely inequitable. And other types of lump sum taxes, for instance, you might want to have a lump sum tax which is conditioned on the ability of individuals. You might think that's a fairer way to introduce a lump sum tax. But obviously the ability is not observable, so that's an impractical lump sum tax as well. Thus we say that the first best tax system in terms of efficiency is unattainable. And in tax system design, we talk about thinking of a second best tax system. Now in designing a second best tax system, there's some kind of guiding principles we might want to follow. Some of these are set out in the Merleys review, which was a big review of tax system design done by the IFS in 2011. And they lay out a few different principles. I've just put a few of them here. So one of them is simplicity. An easy to understand tax system is always going to be fairer for taxpayers and more efficient. A neutral tax system that treats similar activities in similar ways is not going to distort people's choices so much. A stable tax system is going to be more conducive to investment. And finally, and really importantly, we have to evaluate the performance of the tax system and the benefit system as a whole. So we might have certain objectives for the tax system, but it's not necessarily the case that every single tax or every single benefit needs to achieve every single one of those objectives. It's about evaluating the holistic performance of the whole tax and benefit system. And they argue in this review that if we follow these kind of rules of thumb, this is going to minimize welfare losses and administration costs while promoting fairness and transparency for a given distributional outcome. So that's remaining fairly agnostic about what that distributional outcome is, but minimizing welfare losses and so on is something we always want to aim for. So turning now to what our tax system looks like, here's a breakdown of UK tax revenue for 2017-18. And we see that the biggest contributor to UK tax revenue is taxes on labour income. Now these are a form of direct taxes which are levied on an individual or organisation, and these are contributing almost 45% of UK tax revenue. Another form of direct taxes is corporation taxes, which is 8% of tax revenue in that year. And finally, the topic of today's lecture, we have indirect taxes, which are those levied on the sale of a good or service. Together, between VAT, fuel duties, and a set of other smaller indirect taxes, these contributed 30% of tax revenue in that year. And in particular, VAT is the third biggest tax in the UK, raising £125 billion of revenue in that year. And this is enough to fund all health and social care spending in England, so it's a big deal. Now, before I move on further to talk about indirect taxes in more detail, I just wanted to spend one kind of important slide on thinking about why indirect taxes are useful relative to other ones we have in the system. So compared to income tax, for instance, why might indirect taxes be useful? Because actually, in a fairly famous paper, Atkinson and Stiglitz back in 1976 argue that indirect taxes aren't that useful because an income tax is always going to be a much more progressive way to raise revenue because you can target it on people's income. They do have some important assumptions in that might not be reflective of reality. So why might we want indirect taxes to do some of this tax raising? Well, one is actually political economy reasons. So in general, people don't like being taxed. Maybe we want to diversify the tax bases as much as possible, and that will be more. Then we'll be more likely to raise tax. People will be less angered as such by the amount of tax they're paying, and we'll be able to raise more tax revenue. So there's a famous quote from a French finance minister in the 19th century who said the art of taxation is plucking as many feathers from the goose with the least amount of hissing. So that's kind of speaking to that idea of diversifying tax bases as much as possible. A second reason is that indirect taxes provide a way to tax the existing stock of capital. So people that hold wealth, if they want to consume that wealth at some point, they'll have to pay indirect taxes, and that's a second benefit of this type of tax. And finally, and really importantly, there's a number of important efficiency reasons that we might want to have indirect taxes, even aside from externalities, which you'll hear about a lot more in the next lecture. And I'm going to talk about some of these efficiency reasons later on. But for now, I just want you to take it as given that indirect taxes are useful, and I'm going to ask the question as to how they should be designed, given that we do want them. And specifically, that's going to lead me to talk about VAT, which is the biggest indirect tax in the world now. So VAT is actually a fairly new way of raising tax revenue in historical terms. So only about 60 years ago was it actually introduced in France and Germany in the first place. And this graph shows how it's spread all across the world in the last 60 years. So, starting in the 60s where almost no countries had a VAT system, now we have about 170 countries with a VAT system. Now in the past, indirect taxes have been designed a bit differently, because you can think of indirect taxes as being applied to any transaction, any expenditure transaction in the economy. And one way you might want to distinguish between transactions in the economy is those on production, so purchases made by businesses, and those on consumption, so those made by consumers. Now in the past, indirect taxes have applied to both of these types of transactions. And we can see this here in the UK's tax revenue from excise taxes, which are paid by both businesses and consumers. And back in the 60s, over 20% of our tax revenue came from excise taxes, and this has gradually come down over time. And so less reliance on indirect taxes paid in production. Why is that? Well, this kind of reflects this fundamental paper from, well, this paper wasn't the first paper to think about this issue, but it's kind of the formalization of this idea, now known as production efficiency theorem. Now, what does this mean? Production efficiency theorem is a simple idea which says that taxing intermediate goods, so taxing the inputs purchased by businesses, distorts mutually beneficial exchanges in the production side of the economy. And what this does is reduces total output in the economy. Now, Diamond and Merleys, they say that avoiding this taxation of intermediate inputs is thus going to increase total output and maintain the economy at its maximum production efficiency. And they say that this is a Pareto improvement, so at least somebody can be made better off by this increase in total output with nobody being made worse off. Now, to think about this important idea a bit more intuitively, we can think about production efficiency theorem as being closely linked to this principle of neutrality that I mentioned at the beginning. Now, if we taxed production inputs, that's not going to be neutral about the supply chain that businesses choose. In particular, if businesses have to pay taxes on their inputs, they have a pretty strong rationale to vertically integrate in a way that might not be efficient. So you could think about a furniture company would then have a strong incentive to go out and do its own logging, and that's not going to be an efficient outcome. So this production efficiency theorem provides a rationale for only taxing consumption. And this is exactly what VAT does, and this is why it's become such a popular way of raising revenue. Now, VAT taxes consumption by being collected at each stage of the production chain, but allowing businesses to reclaim the VAT that they've paid on their inputs. I'm going to show you how this works now with a little kind of toy supply chain. We've got three firms. Imagine firm A is, let's say, the logging firm. Firm B is a manufacturer, and firm C is a retailer selling to a customer. And in this toy supply chain, we have a VAT rate of 20%. Now, we can analyze this supply chain from the point of transactions or from the point of firms to see how VAT fits into this. So if we look at the point of transactions, we see that firm A makes a sale of £100 to firm B, so £20 of VAT is charged. But firm B is able to reclaim this £20 on that first transaction, so the net VAT liability is £0. So that business-to-business transaction has not been taxed by VAT. A similar case for the second transaction. When it comes to the business-to-consumer sale, a sale of £500, so £100 of VAT, and the consumer can't reclaim that, so £100 of net VAT liability on the final transaction. However, if we analyse this from the responsibilities of firms in this supply chain, we see that each firm has some responsibility for remitting the tax to the tax authority. So firm A has charged £20 on its first transaction, has not reclaimed anything, so it sends £20 to the tax authority. And similar arguments for firm B and firm C, and we see that each firm sends part of the total tax liability to the tax authority, but only the consumption transaction has been taxed. So in this time series, we see the increasing importance of VAT since it's first been introduced in the UK, and the decreasing importance of excise taxes, and this shows this shift from the taxation of production to consumption in the UK, and this is reflected all around the world as well. So just to sum up this part of the lecture, we've just gone over this. Production efficiency theorem is this really important idea in the optimal tax literature, which says that taxing production inputs is only going to reduce total output, and thus we should try and avoid that in order to encourage mutually beneficial exchanges between firms. And this provides a key rationale for the specific design of VAT, because in the VAT system, businesses are able to reclaim the tax they've paid on their inputs. Okay, so the rationale behind VAT is pretty widely agreed upon. Economists generally like VAT as a broad way to design indirect taxes. What's less agreed upon and continues to be debated is whether different goods and services within the VAT system should be treated differently. So should we have different tax rates in that VAT system, or is there a strong case for having just a single tax rate, for instance? And that's what this section is now going to think about. So just to show you the UK's VAT system, back when it was first introduced, the rate was 10%, the main rate was 10%. Gradually over time, that's creeped up to 20%. We've also had a higher rate in the past when it was first introduced. We now have a 5% rate for things like home energy supply. We've always had a 0% rate as well. I haven't included that because it looked a bit ugly. But we have a 0% rate of VAT for things like food bought in supermarkets. And finally, we have some what we call exemptions. An exemption is where no VAT is charged by the business, but they also can't reclaim the VAT on their inputs. Now, this kind of differential treatment of goods and services in the VAT system does lead to some kind of peculiar instances. So there's one case here where slab gingerbread is charged at 0%. Gingerbread men covered in chocolate are charged at 20%, unless this amounts to no more than a couple of dots for eyes. It's a bit of a weird specific rule. And sometimes causes pretty lively debate amongst the public. So in recent years, a prominent example is what's known as the tampon tax. So that's a 5% rate currently charged on female sanitary products, and currently that can't be reduced any lower due to EU regulations. But that garnered a lot of opposition in recent years. I think the petition had over 300,000 signatures for that one. And going back a bit further, what was known as the pasty tax was an attempt to introduce the standard rate of VAT on things like pasties and sausage rolls, and that caused a lot of controversy, and there had to be a U-turn on that one actually. Now, while I'm kind of going through some of the theoretical arguments I'm going to make here, I'm going to have in mind a comparison between two pretty random products. So I've got bread and a tennis racket. I'm just going to come back to these to kind of illustrate some of the theoretical arguments I make as to whether they should be taxed differently. As always, we can look at this from both an equity and an efficiency angle, and I'm going to do that in turn, starting with equity. So to start with, I'm going to be thinking about this question through the lens of vertical equity. Broadly, that's the appropriately different treatment of those with different needs. In practice, this just means redistribution, really. What we often find in many countries around the world, including the UK, is that there are different rates of VAT on different goods and services with the aim of making the tax more progressive. So we have a lower tax on food in the UK because food takes up a large proportion of the budgets of poorer households. Now, I've put this claim up on the board here, which says that VAT is regressive and thus should be made more progressive by varying the tax rate on different goods and services. And what I want to do now is just kind of interrogate this and see whether what we see in policy reality really stands up to a bit of analysis and a bit of data. So I think there's kind of two parts to this claim, which kind of influences policy at the moment. One says that VAT is regressive. Now, regressive is generally defined as the tax rate decreases as income increases. So let's take that definition and look at VAT payments in the UK. So here we have 5 quintiles of the income distribution in the UK, and VAT payments plotted for each one as proportion of household disposable income. And we see that on this definition, VAT appears to be very regressive, with the poorest households spending around 13% of their income on VAT, and the richest households more, like 7.5%. However, I'd argue that this graph is missing something, or maybe doesn't tell the full story. Because what we've got here is income measured at one point in time. And we know that income changes over the life cycle for people. So you can imagine in the bottom quintile here, people with very low incomes right now. Students might be a good example of people with very low incomes right now, but who might expect later on to have much higher incomes and thus spend more than their incomes at the moment. Similarly, you could think about the top quintile here. Some people might have very high incomes in this quintile, but are saving quite a lot, maybe for retirement, for instance. And thus they spend much less than their income, and their VAT relative to income looks quite low. So what about if we compare VAT payments to expenditure, which you might think is smoother over the life cycle? Well, this is the graph we have then. VAT as a percentage of expenditure across the distribution is actually fairly neutral in the UK. Now, I'm not saying that that's the full story. I think both graphs tell you something. But what I would say is that with a slightly more nuanced analysis, thinking a bit more about what we can take away from the data, VAT doesn't seem quite as regressive. But even if you did think that VAT was regressive, even if you just took that first graph, there's a second part to this claim, which says that the VAT system should be made more progressive by varying the tax rate on different goods and services. Now, does this make sense? Well, remember what I mentioned earlier about evaluating the system as a whole. We have different taxes, different benefits we can use to achieve distributional objectives. Now, to show what I mean in the context of the VAT system on this point, I'm going to show you some research that we've been doing in Ghana and some other low and middle income countries about the distributional impacts of the VAT system in those countries. So what's going on here is we're looking at the case of Ghana, which has a range of VAT exemptions for things like basic foodstuffs, public transport, pharmaceuticals, most of which we think are probably aimed at distributional objectives. And what we've done is simulated the impact of removing those VAT exemptions and applying the standard rate, and estimated the change in household purchasing power for each decile of the consumption distribution. And you see here that relative to consumption, removing these VAT exemptions, again, is fairly distributionally neutral in Ghana. Each decile, on average, losing between 2.5% and 3% of initial purchasing power. But that's in proportional terms. We can also look at the cash terms change, which I'll now plot on the opposite axis. And here we see that richer households lose a lot more purchasing power than the poorest households. It's something about 18 times as much as the poorest household. This simply reflects the fact that richer households spend more in absolute terms, and thus, if we had higher VAT rates on average, they're going to lose more purchasing power in cash terms. Now, of course, more VAT means more revenue for the government, and perhaps they can do something with this to compensate, in this hypothetical, households for their reduced purchasing power. So what we do in the next step is imagine that all this additional revenue they've raised from removing these VAT exemptions is then redistributed as a universal cash transfer to every member of the Ghanaian population, and plot the net effects of that twin policy scenario. And then what we see when we plot this is that the poorest households in Ghana are easily compensated by this universal cash transfer that is not targeted in any respect at all by these two. The cash transfers easily outweigh the increase in VAT paid for the poorest households. Now, obviously, this is a big kind of ambitious policy that we've simulated, so it's not at all a policy prescription that this would be a good thing to do. But it does go to show how poorly targeted these preferential VAT rates are at the poorest households in Ghana, and this kind of result is widely found in the developed world as well. So the point I was trying to make with those graphs is that even if you think VAT is regressive, targeting households through VAT rates is always going to be a pretty blunt way to do it. And if we have a functioning benefit system, that's going to be much better targeted towards poorer households. So it's going to be a more efficient way to achieve distributional goals in general. So looking at the two goods that I brought up earlier, bread versus a tennis racket, we'd often find that bread would have a much lower tax rate, a much lower VAT rate than the tennis racket. But actually, it's going to be the richest households that are benefiting much more in cash terms from that lower VAT rate, and we might be better off raising more revenue and redistributing in more targeted ways. So that was all kind of based on vertical equity, so redistributing total resources. There are some broader equity considerations. So for instance, specific purchases might reveal characteristics of parts of the population that you want to target for other reasons. So for instance, having a lower tax rate on wheelchairs might allow you to target a specific part of the population that you would like to redistribute to. And this vertical equity is also not the only definition of equity. We also care about horizontal equity, so that's treating people with similar needs similarly. And if we tax goods and services at different rates, that's going to arbitrarily penalize people and reward people simply based on their preferences. And one final consideration is this idea that perhaps inequality of consumption in specific domains is actually a policy objective rather than total resources. So perhaps we want to equalize consumption of, say, certain food types, and having a lower tax rate on certain food types is going to facilitate this, what's known as specific egalitarianism. So those are just some other considerations for equity, but the broader point I wanted to make was on that was on the total redistribution. Okay, so in the final section, I'm just going to think about some of the efficiency considerations for whether we should treat different goods and services differently. And an important question here is, what is neutral? Now, I mentioned earlier that neutrality is desirable insofar as we don't want to distort people's choices over different alternatives. And this is kind of the point that Atkinson and Stiglitz make in their 1976 paper. Having uniform commodity taxation, in fact they say zero commodity taxation, is going to minimize distortions on consumption. But however, they have this assumption in that paper of weak separability between commodities and work. What that means is they assume there's no relationship between what people choose to consume and how much they work. Now, if that assumption doesn't hold, then actually zero commodity taxation might not be neutral. Now that's because the direct tax system, income taxes, for instance, they provide an implicit subsidy to leisure because work is taxed. Now perhaps if there is a link between consumption choices and work, can we offset some of the disincentive to work created by the direct tax system by taxing different goods and services at different rates? Now we've got lots of evidence to suggest that there is a link between what people choose to consume and how much they work. So for instance, most food products bought in supermarkets are found to be complements to leisure, whereas food eaten out in a restaurant is found to be a substitute for leisure. So one case which is maybe put forward as a particularly strong case for intervening on tax rates because of this argument is childcare. So you can imagine that childcare is the price of childcare is very strongly related to people's choices with respect to work. So maybe having a lower VAT rate on childcare can offset some of the distortion created by the direct tax system. Now this kind of argument can be extended to say that in general there's an efficiency argument for having lower tax rates on things that are complements to formal market activity. So in the previous slide I talked about commodities which are complementary with work. We can also think about services that might be produced at home. So for instance, gardening services. perhaps there's a case for having a lower VAT rate on gardening services, because otherwise people are going to want to produce those services themselves. And particularly important in the developing country context is perhaps there's a case for having a lower tax rate on activity that can easily switch to the informal sector. As I said, kind of tweaking with the tax system this way might help us offset some of the disincentive to work created by other parts of the tax system. This is all quite complicated, so it may be hard to implement in practice, but in theory, this does provide a rationale for tweaking the tax system. So returning to this example, although I've just said that food products such as bread are complements to leisure, we would definitely think that tennis rackets are very complementary to leisure, so perhaps this argument provides a rationale for having a higher tax rate on tennis rackets relative to food products. Now, I said I wasn't going to talk about externalities and internalities so much because the next lecture is going to concentrate on them a lot, but I thought it was just worth mentioning these in the context of the VAT system, because of course in general these do provide a strong efficiency rationale for taxing different goods and services at different rates, but the design of VAT suggests it's not going to be the best tool for addressing these market failures for two reasons. Firstly, VAT is an ad valorem tax, it's charged proportional to price, and this means that if we fiddle with VAT rates, the subsidy implied by a lower VAT rate is going to be proportional to the price, and so the subsidy is going to be higher for higher cost alternatives. And that's not, in general, that's not going to obviously be something we want to do. So you can think, for instance, of rail travel being a good example. We might want to encourage rail travel because relative to car travel, less congestion, less pollution, but it's not clear that we'd want to subsidise first-class rail travel more than standard-class rail travel. So that's an example of this case. And perhaps more importantly, I spoke a lot earlier about how VAT is not charged on production. So fiddling with VAT rates in order to correct market failures is only going to affect consumers' choices and not those of businesses. And these market failures are thus going to be better addressed with excise taxes, for instance. A few final notes on this structure of the VAT system point. So I mentioned earlier the benefits of simplicity and a simple and stable tax system. And we would tend to think that having a single VAT rate is going to be more conducive to a simple and stable tax system for a few reasons. So reduced time and effort for businesses who need to comply with different rates. The Revenue Authority will have less of a workload in terms of determining new products that come onto the market, which VAT rate they should face. And finally, potentially an avoidance of political lobbying invited by having these different tax rates in place. And to kind of illustrate these points, there's a case of the Jaffa cakes. So in the UK, chocolate-covered biscuits are charged at 20% VAT, and chocolate-covered cakes are charged at 0%. And there's a bit of the Jaffa cakes were a marginal case here as to which category they fell into. And so at a tribunal, McVitie's actually baked a giant Jaffa cake to try and prove that they were indeed in the cake category and could face the lower tax rates. So that's just kind of some of the farcical processes that can result from having these different tax rates in place. So just to sum up the whole argument, all the arguments about whether we should tax things differently, in particular with the VAT system. On the equity side, we tend to think that direct taxes and direct benefits are going to be much better at redistributing resources, except for maybe in some very specific cases. On efficiency grounds, there are some genuine economic arguments for having differential rates of VAT, such as offsetting these distortions from the direct tax system, but actually implementing these is going to be really difficult, and we have to think about the specific features of taxes when we think about addressing externalities. So perhaps for VAT, the overall case roughly favours uniformity in the VAT rate, except for some particularly compelling cases such as childcare. And just to sum up again, a few key takeaways. So tax system design needs to trade off efficiency and equity. Indirect taxes, which are those charged on goods and services, are an increasingly important way to raise revenue, and VAT is popular amongst economists for this purpose. In most cases, taxing goods and services differently in pursuit of distributional objectives will be poorly targeted. And as I've just said, varying the tax rate on different purchases can improve efficiency in some cases, but it's not always clear that VAT will be the best way to do this.